All right, everyone, welcome to Chapter 9 of Intro to Business, where we are going to be talking about finance. So, just like in Chapter 8 about accounting, this does give a pretty broad overview of finance as a whole, and that's going to help us learn a little bit more about finance, but you're going to learn a lot more when you take finance-related courses in your degree. So, first off, we want to talk about what motivates financial decisions. So, first off, financial capital refers to the funds a firm uses to acquire its assets and finance its operations. Firms use some of their capital to meet short term obligations like paying bills. Firms use some funds to finance major long term investments like building a new plant with new machines. Firms need funds to pay financial return to the owners in exchange for their investment in the company. And all of those that I just mentioned lead us to one singular concept called finance, the functional area of business that is responsible for funding the best sources of funds and the best ways to use them. But which source is best, right? That's the question we got to answer. What source is best? And to be honest, there's really no solid answer. That's going to depend on the goals of the financial manager and the goals of the business as a whole. So we need to look at shareholder value and social responsibility. So as we mentioned in an earlier lecture, social responsibility is that, you've probably heard that term before, companies being responsible for social actions, right? They need to be responsible socially in some capacity, right? They can't just be all about the business because, as we know at this point, that's not the best. Social responsibility plays into a big part in long-term growth of a company and long-term longevity. So we need to pay attention to that. But the emphasis that financial managers place on maximizing shareholders may seem like it's against social responsibility, right? You need to make decisions that are best for your financial stakeholders and your stockholders because that's your job, right? But that might end up stepping on some people who would think that that's against them, right? So it's this tightrope to walk. In the end, the primary goal of a financial manager is to respect the needs of all stakeholders. So that's your people, investors, that's your customers, that's people who are not your customers, right? Being socially responsible, though, requires a long-term commitment to the needs of the many different stakeholders. Problem is that executive bonuses or raises are tied closely to short-term performance, which will skew their thinking and results, right? Because they're thinking, well, I want to make money, so I'm going to do X, Y, and Z to try and benefit right now. And in addressing the needs of all stakeholders isn't very simple and straightforward. Business leaders and managers need to walk this tightrope to make good decisions for everyone involved. That leads us to risk and return. So you've probably heard of one of the most important lessons in finance, in financial management. There is a trade-off between risk and return. You've probably heard that in life. The greater the risk, the greater the reward. So, what is that? Risk refers to the degree of uncertainty about the outcomes of a decision. The risk-return trade-off suggests that the greater the risk, the greater the reward. The lesser the risk, the lesser the reward. See how it goes hand in hand? If something's more risky, you're probably going to get, or will ideally get, a bigger reward. I mean, why would you take on that risk if you could get the same reward from a safer bet? Managers need to consider that risk reward because they obviously want to do better, but they need to take on that risk to do better. So they need to determine, is it worth taking this risk? So up next, identifying financial needs. So by using ratio analysis, you can identify current strengths and weaknesses of a business just by doing some basic calculations of your own. This is one way that financial managers evaluate a firm's current strengths and weaknesses, right? Through a SWOT analysis, things like that, by computing some of these ratios. This process is called financial ratio analysis, which is computing ratios that compare values of key accounts listed on a firm's financial statements. So back in the previous chapter about accounting, we were talking about how there are those different accounts that we're looking at in a business to see how they're doing. And that's going to lead us to 4 ratios that we're going to be calculating out: liquidity ratio, asset management ratio, leverage ratio, and profitability ratio. So let's start with liquidity ratio. It's a ratio that measures the ability of an organization to convert assets into the cash it needs to pay off liabilities that come due in the next year. So one of the most commonly used liquidity ratios is current ratio, which is computed as current assets divided by current liabilities. Current assets are the things like cash and other assets expected to be converted into cash within the next year. And the larger the ratio, the easier it is for a firm to pay its short-term debts. Up next, asset management ratio is a ratio that measures how effectively an organization uses its assets to generate net income. One thing that they use, or one ratio they use very frequently, is inventory turnover ratio, which is a firm's cost of goods sold or an average inventory levels. Measures how many times a firm's inventory is sold and replaced each year. Having a high turnover ratio is good because it shows that a firm can continue its daily operations with a small amount of inventory on hand, meaning you're taking that inventory, you're pumping it right out the door, right? Another very commonly used one is average collection period, which is the accounts receivable divided by average daily credit sales. Another commonly used ratio, if you were to perform this calculation and let's say you end up with the number 45, that means it takes on average 45 days for a company to pay for their credit purchases. The smaller the ratio, the better, because it shows that you can pay off your debts quicker than others, which is clearly a good thing when we're talking about investing. Up next, we have leverage ratios. So, financial leverage is the use of debt to meet a firm's financing needs. Leverage ratios measure the extent to which a firm uses financial leverage. Common measure is interest coverage. Interest coverage equals firm's annual earnings, pre-interest and tax, divided by annual interest expenses on loans and bonds. Interest ratios below 2.0 signal problems covering future interest payments, right? It's clearly a problem if that's a little bit lower. Then you have profitability ratios, which are ratios that provide measures of how successful they are at achieving this goal. Many different profitability ratios out there, but let's focus on net profit margin, which equals net income divided by total revenue. So you take your net income, you're going to divide that by total revenue, and the larger the percentage of net profit margin that you're going to get through this calculation, the more profit a firm earns on each dollar of revenue. So let's talk about some planning tools, right? There are some ratios listed within your textbook that I want you to go take a look at. But now let's take a step back and look at planning tools. So ratio analysis is an awesome method to identify a firm's current financial strengths and weaknesses. Now we need to develop a plan to build on the firm's strengths or correct its weaknesses. So some basic planning tools is a budgeting process provides financial managers with information they need for financial planning. Budget income statement is the projection showing how a firm's budgeted sales and costs will impact expected net income. A budgeted balance sheet is a projected financial statement that forecasts the types and amounts of assets a firm will need to implement its future plans and how the firm will finance those assets. A cash budget is a detailed forecast of future cash flows that helps financial managers identify when their firm is likely to experience temporary shortages or a surplus of cash. It's great to know the ins and outs of cash flows and when you think there will be less or more cash coming into the business, obviously, because then you can plan a little bit better. So, finding funds, right? So, we all need money. Regardless of what our situation is, we need money. So, once you see how much capital you need to do X, Y, and Z, the next step is to determine where that money is going to come from. So, the most appropriate source of funding will depend on a few different factors. That's going to depend on the firm's stages of development, and the reasons for the needed funds. So let's look at some sources of short-term financing. Some common sources are tax or trade credit, which is financing granted by sellers when they deliver goods and services to the customer without requiring immediate payment. So you don't say that you need to pay right now. It's kind of like a buy now, pay later, meaning you get a shipment and you don't have to pay it right away, which is great. Another one is called factoring, which is when a company provides short-term financing to firms by purchasing their accounts receivable at a discount. You've probably gotten a call from places like this, debt collection agencies. Benefit of this is you no longer have to wait for individuals to pay their bills since it's now another person's problem. Downside is you're not going to get as much money if those people were to actually pay the bills themselves. So that's short-term financing. Now we got to look at long-term financing, right? Looking at the big picture. There's several things we can do to obtain long-term funding. So first off is short-term bank loans, which are bank loans that need to be paid back 30 to 90 days, but can be up to, I believe I skipped over a slide. I'm sorry, I got a little lost there. Sources of short-term financing are short-term bank loans, which is a bank loan that needs to be paid back within 30 to 90 days, but can be up to 1 year in length. It's another form of credit that banks offer you for short-term financing. And a revolving credit agreement is like a line of credit, except the bank makes a formal, legally binding commitment to provide the agreed upon funds. Finally, we have commercial paper, which are short-term promissory notes issued by large corporations, typically carry lower interest rates than commercial banks and change on short-term loans. Not as common. The most common one you'll probably see is the short-term bank loans and trade credit, depending on your reputability. So now we need to look on long-term funds. So what are some things we can do to obtain long-term funds? First off, direct investments from the owners. So the key source of funding for businesses is the money the owner themselves is investing in the company. For corporations, this means selling or issuing new stock. You also have reinvesting profits. So it's also called retained earnings, which represents the share of a firm's earnings used to finance the purchase of assets, pay off liabilities, and reinvest in the business. And to clarify, retained earnings and cash are not the same thing. What is happening? I believe my PowerPoint is all over the place. Sorry about that confusion. I couldn't find which slide I was on. I think that's what happened before, is my slides got mixed up. So, up next, let's talk about leverage and capital structure. So let's talk about the pros and cons of debt financing, right? So leverage is all about leverage within a company, right? And what is the kind of capital that your corporation or your business has, and how can you leverage that, right? So one of the things you've probably heard of, it's a term called debt financing. It's when a company borrows funds, they enter an agreement to pay back those funds, right? So debt financing, a business goes to a bank and says, hey, I will pay you, I want to borrow money, I'll pay you back, right? That's called debt financing. So the pros is firms would acquire more funds without asking existing stockholders for more money or issuing new stock, right? That's a great thing. And interest payments used to be less expensive. Now, clearly it's a little bit different, but it used to be much less expensive. So some of the cons of debt financing is requirements to make fixed payments. No matter what the day or situation is, you always owe a fixed payment for this loan. And creditors can impose covenants on borrowers, which limit what a company can do in regard to the loan agreement. Up next, pros and cons of equity financing. So some of the pros of equity financing, which is financing by using your company's equity that they have. Equity financing is more flexible, less debt than financing due to the way it's structured, and imposes no required payments. The firm can skip dividend payments to stockholders without having to worry that it will be pushed into bankruptcy, which is great. Some of the cons is it doesn't yield the same tax benefits as debt financing, and companies that rely mainly on equity financing forgoes the opportunity to use financial leverage. I am very sorry about the confusion with this chapter today. Last thing I want to talk about is managing assets on our final two slides. So, two of the most main assets you're going to encounter is cash. So cash is great, but it has one major downside compared to the other assets. It earns little to no return. If you just sit around with money all the time, right, you're losing money. That's called inflation. If you look at your salary or your income at the start of 2022 and at the end of 2022, you're going to see that there is a huge difference in what you could buy, right? Because of the inflation rate, which is around 8% by the end of the year. So if a company holds too much cash, they're effectively losing money. That's why investing is so great, because it helps beat or combat inflation. There are several things companies can do with their funds instead, such as invest in bonds, treasury bills, money market mutual funds, as we have discussed and will still continue to discuss. Last thing is managing accounts receivable. Accounts receivable represents what customers who buy on credit owe the firm, right? So if I go to the Gap and I purchase clothes on a line of credit, that's essentially they have an accounts receivable. I owe them money. I'm going to pay them money. When a company offers lines of credit, they need to set policies in place to manage that credit, right? They can't just let it run hog wild. They need to have rules, otherwise they're going to get themselves in a real pickle, such as setting credit terms, establishing different credit standards by saying, you know what, if you want our credit card, you need an X number credit score, so maybe a 650 or a 750, and deciding on an appropriate collection policy. How aggressive or not aggressive should you be? So that is the end of finance, our chapter 9 on finance. I want to thank you all, and I want you to please accept my sincerest apologies about any of the confusion earlier in the slide. Things got a little hairy there. All right, if you have any questions, please feel free to reach out to me, and I am happy to help. Thank you. Bye-bye.